Hello, everyone. I'm Fyruz Khan, and today I'm back with a brand new class with a brand new lesson. So, we're going to have a very interesting day today. If you haven't liked our Facebook page, you can just type in Fyruz Education Services and like our page because we have lots of free educational content for you. You could also subscribe to our YouTube channel. Again, just type in Fyruz Education Services, and we have over 85 videos. It's all free, full lectures, and it's more convenient on YouTube because it's all compiled on playlists. So subscribe today, hit the bell icon. You will get notifications whenever we upload a new video. So let's go ahead. So today, I would like to start off with something very interesting. Think about a manufacturing business. Okay, so look at the picture. Imagine a manufacturing business that makes products, that makes goods. Okay, that makes tangible items. Tangible items means you can touch these products. Okay, you can hold, you can touch, you can feel, you can measure the size. But then, if you think about service businesses that provides services, like if you go to a barber shop, if you go to a movie theater, if you go to a restaurant, a hotel, or even an education institution, college, university, they all provide services, and services are intangible. You can't see them, you can't hold them, you can't feel them. What you can do is you can experience them, right? When you go to a movie theater, you can watch a film, you can experience the magic, come back, but you can't have the product put inside your pocket and come back. No, you can't do that. But in terms of this phone, I can buy it, put it inside my pocket, and then come back home. So that's a difference. So think about a manufacturing business that makes products. Products are tangible items. You can hold them, you can see them, just like these cardboard boxes, okay? There are products inside them. And think about a business that makes garments, that makes clothes, okay? And let's say they've made 5,000 pieces of trousers, okay? 5,000 pieces of trousers. Out of 5,000, let's assume or let's say that they have sold 3,000 pieces, okay? So you have 5,000, you've sold 3,000. 2,000 pieces are still left. So, what are those 2,000 pieces going to do? What do you do with them? So, you store these 2,000 pieces in a warehouse. And when you store them, it becomes stock or inventories. Stock or inventories are the same thing. So, you have 5,000 pieces of trousers, you've sold 2,000 pieces, and you've sold 3,000 pieces, and 2,000 pieces are left. What do you do with that? You store it in a warehouse, and that becomes a stock. That becomes inventories. And stock can be in various forms. It could be raw materials. In terms of trousers, it could be the fabric that you've stored in your warehouse. It could be buttons. It could be elastics. It could be other different items. It could be laces. For phones, probably you may have a finished product like phones. You can also have spare parts in stock like screens or jacks or microchips. So that's that. And you could also have work in progress, like you're making it, it's halfway there, and you store it. Okay, let's say you've got the outline of the trousers and you haven't done anything, and you store it because you're waiting for the other production line to take it. Okay, so even work in progress could be stock. So you could have a full product in stock or inventories, you could have raw materials, you could have work in progress. Three things: full product, um, work in progress, and raw materials. So, how do you record inventories? Now, when you have stocks or inventories, it's very simple. you record at the purchase price. Let's say our purchase price for those 5,000 pieces of trousers were $10,000, and I will record $10,000 for those 5,000 pieces of trousers. It is that simple. Okay. Or we could also, record at their net realizable value, NRV, and we will talk about this more. So NRV is something, so think about one t-shirt, one piece of t-shirt. Let's talk about this t-shirt, right? And you have this t-shirt in your stock for a long time. And this t-shirt, has gone out of fashion. Okay. But now you see the market and you know that you can sell this t-shirt for $60. Okay. $20 less than their actual price, right? Why are you selling it less price? Because it has gone out of fashion. And then you also need to spend $10 more in terms of marketing costs. Now you need to market that t-shirt. You need to, let's say, make social media posts, boost it on Facebook or Instagram, and attract audience. So the new price is $60, not $80, because it has gone out of fashion and you've reduced it. And you spent additional $10 in terms of marketing cost. So when you deduct it, it's $50. So $50 is your NRV, net realizable value. Okay, so original price was $80, but it has come down to $60 because it has gone out of fashion, and you've spent $10 more. Okay, because you need to market the product, and this $50 is your NRV. Okay, so according to conventional accounting rule, it is said that you have to take the lowest price possible. You have to deduct everything when your product lies in your warehouse and when you have to sell it. If there are any costs associated with it, if the goods get damaged or if the goods is out of fashion, you have to minus it, okay, with the original historical cost or with the expected cost, okay? And that is your NRV. So NRV is expected selling price, okay, minus cost. Because sometimes when your product is in your warehouse for a long time, it cannot be sold in the original price, in the historical cost. No, you have to reduce it. And then there may be other costs, other costs may be associated with it, extra cost, and you have to minus that, right? So for NRV, we need, again, three things. The first thing that we need is you have to determine the market value, the expected price, okay? And then you have to look at all the cost. In this case, for this t-shirt, the expected value is $60. It has gone down $20 from $80 because it has gone out of fashion, okay? And then we have marketing cost, $10, okay? And then you have to deduct it. You have to find out the difference. These are the three things that we need for NRV. Net realizable value. Expected cost. Second thing, you need to look expected price. Second thing is the costs associated with it. And then the difference, you minus it. So valuation of inventories. Inventories are unsold goods. I told you it could be in the form of a full product, a ready-made product. It's ready. It's in this warehouse in the form of stocks because it's unsold. Probably there's no demand, or there will be demand in the future, or someone has ordered. You're waiting to ship the product. It could also be in the form of raw materials, right? In terms of phone, you may have screen, you may have microchips, you may have audio jacks, you may have, other parts of the phone. And there could be work in progress. Let's say you've made the phone, but it's not complete. Probably you need to work on it more. Okay? So that's that. And inventories has to be recorded in their original purchase price or historical cost or in the net realizable value, NRV, which we have talked about. Now, think about, this is quite interesting. Pay your attention. So let's say a shoe shop has 10 pairs of shoes and each pair is sold at $10. Okay? You've sold 7 pairs and 3 pairs are left in your stock. So you've sold 7 pairs and the rest 3 pairs, you take it in your stock and you keep it. And a year has passed and you see that those shoes has gone out of fashion. Okay? And you have 3 pairs, which means $10 into 3 pairs is $30. Okay? And $30 is at risk because these pairs of shoes have gone out of fashion. And now the shopkeeper or the manager of the shoe company or the owner of the shoe company believes that they can sell it in $8 a pair. It's no more $10 a pair, it's $8. Why? Because they have gone out of fashion. Okay? So when you sell 3 pairs in $8, it is $24. So now your net realizable value is $24. The price that you're going to, put it in your income statement or financial position statement is $24, not $30. Okay? So that's what you are going to do because you've stored it, they've gone out of fashion, and you can't sell it in $10 anymore. It's $8 a pair, and this should appear on the statement of financial position as $24, not $30, because the conservatism principle states that losses has to be recorded, and then $24, the reduced price has to appear on the financial position. Okay, statement of financial position. So this is an example. This is example number 1. The second situation could be, let's say you have a table. Okay, let's say you have a study table of $60 and it has been damaged. Sometimes, goods may be damaged when you transfer from one place to the other, or when you keep it for a long time in your warehouse, goods may be damaged. So let's say this something has spilled on the table and you have to spend $20 more. So altogether, total money spent on the table is $80. You bought it for $60. You've spent an additional money of $20. But now you think that the expected market value, because it has surpassed some time, the expected market value is $70. Okay? But can you enter $70 as your expected price? I don't think so. You can't put $70 because this is against the principle of conservatism, because you have actually spent additional $20 to repair this item, and it does not address that. So you can't do that. According to principle of conservatism, all the costs have to be deducted. The lowest price possible has to be on the statement of financial position. Now, do you think that $60 can be entered? No, $60 also cannot be entered because it ignores the fact that the table was damaged and it required a repair. So what's the answer? The answer is you have to take the expected price, and minus $20. So $50 will be your net realizable value, will be the actual value of the asset, because that is $70 is the expected price in which you want to sell the product, $70, and you spent additional $20 on repairing the table, and then $50 is the value that you need to enter into your accounts. Okay, so that's that. So today we had a short class. We have finished this chapter successfully. So we started with talking about talking about stocks, talking about inventories, we talked about historical cost, and we talked about net realizable value. And I have given you different examples, right? So that's that. Thank you very much for attending the class. If you have any questions, please do not hesitate to comment down on the comment section, right? I will take your question anytime. Do not forget to like our page, Fyruz Education Services. Please press the subscribe button on our YouTube channel. 50% of the viewers are, have did not subscribe to our channel. So just press it. It's free. And also hit the bell icon so you will get notifications whenever we upload. We have great plans in uploading really good educational content over the next few months. So that's that. Thank you very much. Have a good day. Have a good weekend in Bangladesh, and all of the world. Enjoy the rest of the week. Thank you.